Live Coaching. My name's Jack, I'm your Tradimo coach, as you already know. Tonight we're going to be focusing on an introduction to gaps, and then in the coming sort of couple of weeks we'll have a little look at ways to trade them. We're going to have a little brief look at how to trade them today. So if you are interested, obviously in evening sessions, you can attend 6 o'clock London time, Monday to Friday. You will find, guys, in the download box, it's getting quite big now, there is a gap finder for your MT4. It's one that I found. I am actually having one made, which should be a bit better. For that gap finder, all you need to do is compile it and save it into your computer. We'll go into that at the end. As well as that, there is a brief PowerPoint of some of the stuff that we are obviously going to be going through tonight, guys. So how does that sound? Everyone happy to go through a bit of gap trading tonight then? Good, because I know Brenda and a couple of the guys have asked for it. So as always, we're going to start with a disclaimer, and then we'll get cracking. Spread bet in FX and CFD trading carry a high level of risk to capital and can result in losses that may exceed the initial deposit. Trading of these products may not be suitable for everyone, so please ensure that you understand all of the risks associated with trading. Information and comments provided herein under no circumstance are to be considered an offer or solicitation to invest, and all information provided is believed accurate at the time of production. About 4 or 5 minutes past 6, 17th of March. Happy St. Patrick's Day to you, 2014. Nothing herein should be construed as investment advice. Information provided within this room is the personal opinion of me, the moderator, that is Jack, and not Tradimo, and this content therefore does not constitute financial, investment or tax advice, and Tradimo does not accept any liability for the content of or comments made during the session. So tonight, guys, I thought we'd have a little bit of an introduction to gap trading, developing a strategy for gaps. How many of you have actually traded with gaps before in the past? Brenda or anyone of you, have any of you traded with them before? Because it's okay if you haven't. A little bit. Well, don't really notice it. Well, basically, guys, as we already know, okay, it's pretty simple. A gap is an unfilled area on the chart. You see me banging on about it all of the time. And generally, guys, when it comes to gap trading, it's very much a case of having to try and read sentiment of the market. It's not the easiest thing in the world. It can be quite an advanced thing to trade, but I have traded it for a number of years with pretty decent success. I actually have an advanced gap strategy. It is available to all Platinum members on Tradimo. I'll show you a back test of that at some point. And basically, guys, when it comes to trading gaps, there are a few things we need to understand. Okay, more often than not, when a gap occurs, as we already know, it will be filled at some point. It's a point of attraction, it's a magnet. So you can use it in sort of one or two ways. You can use it as a profit target. So when you're looking to trade, you can actually look for the gap to become a profit target. And let's have a little look at an example, shall we? On the chart here, we can see that we have, by this red line, a nice gap on the S&P. Okay, we can see it right here. And generally, guys, gaps will give you a point of attraction, this area here. And what will happen is basically price will gap up or gap down. And then people, when it opens, they will remember this gap, this area on the chart here. And so you can either look to trade for a reversal of the gap, or what you can do is, if you have a signal, like we can see with this example, we get a nice shooting star. You can actually use it to place profit targets. And if we had used a trade and had a little bit of a short trade on the chart, okay, like we have here, what you will find is, you know, where do I put my profit target? Well, we have a little bit of an area here. We could put a profit target, but you can also use an area that needs to be filled on the chart to give you another place where you can pop it in. Okay, and you can see that quite quickly this gap's obviously been filled. So there are a couple of types of gaps. You hear me banging on about it all of the time, guys. Okay, there are two main types of gap. One is stronger than the other. You have a gap which is the difference between the close of one day and the open of the next day. Okay, and generally the gap on this example here, and it's known as not an open close gap but a high low gap. And what you find is it will generally gap into an area that has not been traded on this day here. So you get one day, we close, and then we gap lower here. Okay, and this area here gives you a very strong indication that potentially that gap will be filled. Okay, or it could continue. The second type of gap is actually one that we see here, guys. Can you see what happens? We close on this candle here, and we actually open higher. We actually open at a decent price, different price, but we do not actually breach the day's high. So what this gap is known as, it is known as an open close gap. Okay, and the open close gaps are very, very common. We can see that generally speaking, they happen a lot. We have an open close gap here where we close up here and we open a little bit lower. Okay, and then we fill the gap. That is an open close gap, very, very common. We also have the high low gap. We can see that the high of one day and the open of another day, there's thin air between there, a bit like single prints, guys. It's a bit of a vacuum. And then we also have another example here where we close, open above the high of the day, and then we pretty much come in and fill the gap. So they are the two types of gaps. Now when it comes to trading, I will generally trade with different risk parameters on each gap that I see, and there are sort of 4 or 5 different types of gaps that you have to identify because it will help to give you a bullish or bearish sentiment. And we can see in this example here, okay, it is a high-low gap, but there are a few different types of gaps actually on the chart that do fall into high-low open close gaps. Does everyone follow me so far? Everyone happy with that? Yep. Bottle Torch Boy Robot and Brenza? Yeah, okay, good. So the way I look at it is very, very simple. A high-low gap, I will risk double what I will risk on an open close gap, whereby we gap and we open within the prior day's range. Okay, I will risk a lot less on this, and generally speaking, I will use these open close gaps for profit targets if I'm having a trade. Okay, I generally won't use them necessarily when we open lower to try and fill. Okay, I won't look at that to get filled. It won't be a trade that I take. Whereas a trade like this, a gap like this, may be something that I actually take to actually trade, and I can actually formulate a whole position from the high-low gap. Okay, it's very, very important, guys, that you remember that. Okay, the close gaps are very, very common. What sort of markets do we think that they are more common in, guys? You know, where are gaps likely to be more common, do we think? What sort of markets? Stocks, yeah, absolutely. Why are they more common in stocks or commodities or, you know, bonds, futures, other markets? Absolutely. Okay, a gap will occur when a market closes, but as well as that, guys, we have also seen on numerous occasions when we have a look at a chart and we pop onto a 5-minute, okay, we also get lots and lots of gaps, and they're very, very difficult to see because quite often they get filled, but you will quite often see very small gaps occur, okay, over data events. Do you know potentially why that might be the case? And if we actually have a little look, you can see that we have a open close gap, okay, here on the chart. Okay, and what I'll do is I'll mark that up and I will highlight that for you. So we will zoom in. Okay, you can see that we actually close at this price here, but see the wide area. Okay, it does actually occur on a 5-minute chart. Absolutely, it can be a technical issue. It can be due to another things. There's another gap here that we can see between here and here. It could be your broker feed, but it can also be because of liquidity. And during periods of time and data, for example, and when a market is illiquid, you're very much likely to get these gaps. Now, generally speaking, again, when it comes to trading gaps, the daily time frame is the one that I will use more than anything. Okay, because a daily gap is a very, very good indication of potentially market sentiment, and it is stronger. A 5-minute gap, I just don't know whether it's maybe my broker or whether it's a liquidity gap. So it's very, very hard to decide. So what I like to do is I potentially, when I trade gaps, we'll use, okay, just a daily chart, okay, and we'll talk about the different types of gaps as we go on. But we will see a very, very good example of a daily gap of how they can be filled. Okay, because generally speaking, guys, gaps will be points of attraction. They don't have to fill the next day. Okay, so this is very, very important, guys. You have to have a sentiment and decide whether it's going to fill the next day. But at some point, they will get filled. And we can see in the example here in cable, in the euro dollar, sorry, that we actually have, after the weekend, what is known as a high-low gap. We can see that the difference between the high of this day and the open of this day is this area on the chart. Okay, we actually gap a little bit higher. Okay, we can see it here. Now, we actually open all the way up here, which gives us a bigger gap. It's easier to see, but at some point we move higher. Okay, a continuation gap forms and we continue to move higher up to a trend, and then have a little look what happens, guys. Okay, basically market begins to move lower, and what happens, we fill the gap pretty much, first of all, to the high low. Okay, and that is the strongest indication, and then we also literally to within a couple of pips, look at this, we fill the close gap as well, and then we bounce, and if you actually have a little look, cable has not looked back from there. So for that instance as well, guys, you know, you can trade gaps for bounces, and we'll have a little look at two examples on the chart. Okay, you can actually trade once the gap has been filled. Okay, and we're going to use this example to show you how we can do that. Okay, so guys, basically speaking, that is the gap. What a gap is, that is the nature of gap. Very, very easy, guys. We're doing a nice, easy introduction. Okay, but there are a few different types of gaps. We can see that one has been filled here. What is this gap known as, guys? What sort of gap is this in the market, would you say? It is a high-low gap, or is it an open-close gap? A close high, absolutely. So is it a strong gap, would you say? Is it a strong signal? Or is it the weaker of the two signals that we see? When you look at that gap and you see how it's traded. What do you reckon, Bottle Torch Brenzer? Okay, well, there's only two types, okay, and the strongest ones, as I say, are the ones where we actually open much lower than the low of the day, or we open much higher than the high of the day. Basically, when this gap opens, okay, ignore this whole area here on the chart. We open down here, and when we open, none of this has been filled in yet, so it's just white area. So it is a strong gap, whereas when we open within the prior day's range, okay, that is a weaker gap. We can see here that we close up, but we open a little bit lower, okay, and that is a weaker gap, okay, but that is a strong gap signal when we do that. However, as well as this, guys, there are a few different types of gaps, and we have to understand the sentiment of them. Okay, the first gap and the most common gap is the actual common gap itself. It's otherwise known as a trading gap or an area gap. Okay, and when it comes to trading these, it can be very, very difficult. Okay, and generally speaking, common gaps will be used as just placing profit targets, looking for an existing trade that you put on, rather than seeing the gap occur. And we can see that we close here, we open here, and rather than selling it on the open, looking for a move to fill the gap, okay, what we do is when price moves up and continues to move up, when we get a sell signal and we can see that we get a lovely shooting star here at the top of a range that we're in, we look to get short, and our profit target is pretty much the gap area, okay, either the low before we enter into the gap or right in the middle of that gap range. Okay, guys, does that make sense to you? Okay, and the common gap is the most common, and that is why it's called it. It is not generally caused by fundamental shifts in sentiment. And what I mean by this, guys, is it's generally not caused by, you know, the Ukraine situation, where the market decides that Ukraine and Russia are going to go to war and the stock markets are going to gap down. It's not caused by ECB comments generally. It's not caused by, a geopolitical event, a natural disaster. It is basically caused by maybe a small comment, maybe a small data event, okay? But it does not generally indicate a change in sentiment like some of the other gaps that we get. What it generally does is it basically occurs for no reason. And there's a very common thing, okay? In stock markets, gaps occur all of the time, okay? And what we're going to do is we're going to have a little look at DuPont, okay? Gaps occur all of the time because of illiquidity, okay? Now, a common gap will generally occur quite a lot in the stock market, and it will occur because, okay, of things like a company paying out day before it pays its dividend out, or day before its earnings, or day before something small happening. It's very, very well known. And generally, common gaps are not easy to trade. There is a characteristic of a common gap, okay? And I'm going to show you an example on the chart now. And I'm going to highlight an area for you, okay? A common gap will generally occur when a market is in a bit of a range, okay? Now, we can see already, if I just change this rectangle to a nice khaki, there you go. Okay, now we can see that the market here is in a trend, okay? It's moving lower, but it does begin to range, guys. We can see quite clearly the market is beginning to range, okay? And now a common gap will generally occur within that range. So if we move along and we come to this area here, with this candle here, okay, we can see that we get a common gap. And generally speaking, a common gap will occur in the middle of a range, okay? And when that common gap occurs in the middle of a range, do you think it's easy to trade, guys? Do you think you should be maybe selling it on the open for that gap to fill, given the congestion area? Absolutely not. It would be very hard to decide, okay? As well as that, there is always volume that can be used, okay? And generally speaking, when you get a common gap, okay, the volume that will occur before the gap and generally around that gap will be an average volume, okay, or slightly above average, maybe slightly below. And we can see in this example that when we enter into a range, our volume between this red line and this red line isn't actually trading massively higher, is it? Okay, we can see that we have a few low volume days, we have a couple of bigger volume days, okay, but as well as that, the predominant theme is generally, look, we're trading in, this is below average, we're trading an above average volume, okay, agreed, because we know when there's a lot of volume because we get a lot of volume here. Okay, everyone happy with that? What do you think, Brenza, Bottle Torch, Boy Robot? Good. Okay, and if you've got any questions, guys, pop them into the box. So generally speaking, when you look at a volume, a gap that is basically common, okay, generally it will mean that the trading opportunities with it are limited. Okay, generally I would rather use this as a profit target if it doesn't get filled. And in this example, as I've said, price moves up, I wouldn't be looking for this gap to fill. What I would be looking for is if I enter into a short trade, I would be aware of those gaps filling. A bit like, guys, when we have a little look at single prints on a chart, remember we look at the dollar CAD as a prime example, okay? We are not going to enter into a short trade in this dollar CAD, are we? Okay, we're in a bull trend. But if we actually do break our low, we know that we have a potential profit target because there are single prints to this point in the chart. And so what I will do is I will use this as a place where I can look to see what price is doing and look to see to take profit. It's very, very important to know that, you know, most traders will not trade the common gap. However, it's very difficult to decide. That is why you need to say, well, is it in a range? Is the volume higher when we gap? No, no, no. Fine, I'm not going to trade it. Okay, guys, that is the common gap. Okay, the next gap is the breakout gap, and these are the gaps that we really like. Okay, these gaps will generally occur, okay, when price is trading within a range, and these gaps are the ones that I really like trading. Okay, because basically it will usually indicate either a fundamental shift in sentiment. Okay, and what I mean by that is the market is ranging and then something might come out at the weekend and we gap lower. Okay, and or it could be that there are stops triggered in the period when this occurs. Okay, so what happens is we open, and basically at some point, and we can see that we have a nice support level here, so most people's stops will probably be around here, and generally it will trigger stops and it will force the market down or above. And what that means is it means that you can actually trade using these breakout gaps. Okay, and you always do one or two things. If it looks like a breakout gap, okay, there will be a couple of characteristics and you will always go with the gap. Okay, so if you pop back to our chart, in fact, let's pop back to our DuPont chart. Okay, there is a good example of a breakout gap occurring up here. So we can see that, okay, price has been in a bit of an uptrend. Okay, we can see that it's been in a bit of an uptrend. Okay, but then what has happened between this area and this area, we formed a little bit of a range, haven't we? And we can see that, volume generally has been pretty low. Okay, it's very low. Look, on the rest of the up move, we see low volume. Okay, and then what happens is, if we just zoom in so we can see it a little bit better, okay, we can see that our support level that we have on the chart, which is sort of around this area here, or even around this area, but it's a support zone, so around this area, okay, it gets broken. We gap below that and we see that price breaks out. It moves lower and it continues to move lower. Okay, and these gaps are best after a long period of ranging, but they are very good, at the top and bottoms of markets. Okay, and they, strictly speaking, will either go against the trend if it is in a longer term trend, or they will go pretty much when you've been in a long term range anyway. They can go any direction. We could have a gap higher or a gap lower. Okay, for example, look, we can see another common gap here. It gets filled right in the middle of a range. Another common gap here, but this actually occurs at the top of market, so that's a bit of an odd one. But basically, guys, there are some characteristics, as I've said. We have to have been ranging, and generally with me, you have had to have been ranging for at least 10 trading days, which is 2 weeks. Okay, that if it's on a daily chart, we can see we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16 trading days, guys. So nearly a month. Okay, but for me, a minimum of 10 trading days for a breakout gap. We have to also break the range completely, and that means breaking the low of the support zone, and we can see that we do that here. Okay, we actually open below the swing low. And the other characteristic when it comes to trading these breakout gaps, okay, is generally you will see volume at a decent level. Okay, you will see a spike up from the prior day's volume, and generally you will see it trade above the average of the period that you have been ranging. And in this example, we can see that we actually have a spike of volume here. Okay, we can see we gap, and we do have a nice little spike in volume, but that volume isn't the highest that we've had, okay, in the range. But it is worth noting that it is significantly higher, guys, than the volume from the prior days before. Okay, so generally, ideally we wanted to see a spike in volume like this indicating a breakout, but it's okay if we don't. All we need to do is adjust our risk parameters. Okay, what we do is we basically, if we don't have volume that spikes above our 20-day sort of average by, the swing high, so it has to be above the highest area here, which would be this candle. Okay, what we need to do is we need to risk probably about 25 to 50% less on the trade. And again, that's just what I do. Okay, it's not necessarily what you have to do, but it's just what I do in the market. Okay, guys? So, in this example, we can see that basically price moves up, breaks the low of the range, we trigger stops. Okay, price moves down on the day, we make an attempt to fill the gap, we miss it, and we continue moving lower, and we've not been back up there, guys, in DuPont. Okay, we've literally still not filled that gap. We may have filled the gap, actually. Should we have a little look? Gap comes in around 53. And have a little look, guys. We can actually see that we have filled the gap, but it did take over a year to fill it. So that's impressive. Okay. So just bear that in mind. Another good thing about gaps, guys, just as a point of interest whilst we're here and we're looking at this chart, is have you ever noticed something? We get the gap and it gets filled eventually. What's happened here on the chart around the gap, guys? Bottle torch, Brenza. It's become a resistance, absolutely. So quite often with these breakout gaps, okay, quite often they will become a resistance level. And if we have a little look with a DuPont one, this isn't a very big range. Would you say that this is a very, very good support level when we look at it here? Would you say that as it stands is a very good support level, or, well, support level now it's a resistance level? Or would you say this area here on the chart, would you say that's quite a good support level, guys, around here? Sort of this area on the chart from here to here? Or this area on the chart? Would you say that's a good support area? Absolutely. But for some reason, the gap itself has become a really good support and resistance area. And there's another good example on this chart, guys, and I'm going to take you to it now. Okay, I'm going to delete these lines. I'm going to mark them back up. Okay, and have a little look on this chart. Okay, now this is just a common gap. It does break out from a smaller range, but have a little look. Okay, we have a bit of a gap form here, but that gap basically reinforces. Now at this point it's a little bit of a support level, isn't it, guys? Have a little look. Okay, we have a little bit of a support level here. It's not the best, but it's a pretty decent little support level. But all of a sudden what happens is once that gap gets filled again, it becomes a really, really good level, and it lasts for over a year, guys, and then it becomes a resistance. And then, it's become a bit congested, but it's still people are still remembering that gap. Okay, so, very, very interesting point that these levels will often become support and resistance zones when we're trading them. So that is the breakout gap. Okay, the next one is the runaway gap. Now, how many of you guys have heard of the runaway gap? These are the ones that basically occur when the market is in a trend. Okay, and a runaway gap is basically characterized by the following. Okay, if we zoom into the chart here, DuPont, they're not the most liquid, but there is an example of a runaway gap, and we can see that the runaway gap occurs. Let me just find one. Looking pretty rare on this chart. Interesting. Doesn't appear to be a good one. Here we have a good one here. It does get filled. It's maybe not the best example we've ever seen, but a runaway gap is basically a gap that occurs when we are already in an existing trend. So we can see on the chart here, we have an uptrend that forms. Okay, and generally a runaway gap, a good example of a runaway gap would be something like this. Okay, and basically what happens is we're in a trend, we open higher, and the trend continues to move. Okay, these are very, very rare, these gaps, guys. They are very, very, very rare because price will try and fill them in. If we actually have a little look at the S&P, I believe there is, or maybe even in that DAX, I believe there is a good example of a runaway gap. So we'll just pop the pretty Tradimo template up. And you can see, look, they're very, very rare because they are similar to a breakout. There you go, guys. There's a little bit of a runaway gap. We're in an uptrend. We break higher, but it's not that we're looking for. It is actually when we're in a heavy trend. So doesn't look like I can find one in the DAX. And as I say, they are much rarer. And the problem with runaway gaps, guys, are they quite often get mistaken for breakout gaps. Okay, they do quite often get mistaken for breakout gaps. And most of them will get filled pretty soon. So again, we're having trouble finding one. Again, we can see another example of a good breakout gap, guys, here in the S&P. We move lower afterwards. But again, doesn't seem to be a, and this is on the hourly. Let's try the daily now. No, doesn't appear to be one. Okay, so very, very rare the runaway gap, guys. But the runaway gap will have certain characteristics if we pop to the slide. Okay, the runaway gap will pretty much have massive volume on it. Okay, because it will generally indicate, again, people getting stopped out and a complete liquidation of people going against market. In terms of indicators that you can use for trading with these runaway gaps, okay, ADX is always a nice one. If we actually pop back to our daily chart, and we'll use this as a runaway gap because strictly speaking, it is a runaway gap. Okay. When you're looking at them, have a little look to see what the ADX is doing. You will generally notice that the ADX will be above the 25 level or the 20 level. Okay, so it's above 20 and it's above 25 when the gap occurs around here, but it will not be significantly at its highs. Okay, because when ADX comes up here, that generally indicates at some point we're going to have to hit a range, but it will be trading at above average volume, guys. That ADX above average value. Okay, because a runaway trend is part of a bigger trend that's in the market, and it's very, very important. There's a bit of a runaway trend there, down move, and then we move down. Okay, and generally you want the ADX to be, you know, around maybe 30, 35, and that will tell you that there's upside, because generally if the ADX goes too high, in this example around 55 seems to be its peak, you know, that can tell you that potentially we're going to get a quick reversal. Okay, so the runaway gap, very, very good. Another one for the runaway gap is that everyone's favorite, our average true range. How do you think this average true range is important, guys? Brenza, Bottle Torch, Boy Robot. How do we think this ATR can be important for the runaway? It's also known as a continuation gap, by the way, guys. Not sure. Okay, well, the ATR is very, very good for these continuation gaps. And the reason it's very, very good is because generally you want to see it ticking up. Okay, you want to see it above, again, the average. We can see that the average of this ATR is around here, and then we enter into a trend, because when the ATR is ticking up, that tells us we're entering into volatility, and that volatility means we're probably going to continue, okay, potentially going to continue with the trend. If our ATR was down here and we had a gap, okay, and it's the same with your range, okay, with your common gaps, okay. If the ATR is too low, it can indicate that a trend is going to break, but generally these gaps will occur once a trend is already started. And what we mean by that is we mean it already occurs and basically signals an acceleration. So you should see this ATR begin to get steeper. Okay, yeah, absolutely. And also the daily range is important, Brenza. Okay. The breakout gap is my favorite one to trade. The runaway gap is my least favorite to trade, because generally speaking, it's, you know, it's very difficult. And for me, there are certain asset classes where gaps are better. For example, single stocks. I don't like trading gaps in single stocks unless it is at a very extreme of a market. Okay, and this brings me on to the next point. Okay, the other ones that I like to trade, and I'm going to show you a little strategy for trading this. Okay, is the exhaustion gap. Okay, the exhaustion gap, very, very important, guys. It can be used, and I've used the wrong slideshow on the last slide, so I apologize. Basically, this one here is massively important. Okay, the reason it's so important is because it will signal a reversal in the market, and these gaps will always happen near the end of a trend. Okay, we can see we have a nice big up move here, then we gap higher, and an exhaustion gap is very, very easy in terms of how it basically is read, because an exhaustion gap will occur pretty much at the high of a move. Now, the only problem with exhaustion gaps are that they will hopefully, in their best case scenario, signal a complete reversal in trend. But you do get in stocks a lot of these gaps. Okay, so the characteristics we are looking for with an exhaustion gap, very, very simple. Okay, we are looking for price to have accelerated into a trend. Okay, just a big straight up move. We are looking for price to basically have carried on in an uptrend and then gapped above the prior high. Okay, so if we look at this area on the chart, can you see, guys? Can you see this area okay? Good. Excuse me, just sniffed there, sneezed there. Okay, so guys, you will generally see a big trend. Okay, now the best exhaustion gaps will occur when the market has continued to make higher highs over a significant amount of days, and we'll talk about that in a second when I give you a little strategy. Okay, so it keeps making higher highs. An exhaustion gap is not as good. It's still strong, but it's not as good when you've had a big up move and then you begin to range. And the reason is because we want to see the market go accelerate and then just reverse. Okay, whereas if it goes up, it consolidates, you've got bull and bears doing battle, and it gets choppy. Okay, so in this example, we can see we have an exhaustion gap, but it's not the best exhaustion gap because we haven't had, you know, a few up days in a row or a decent higher high. Okay, whereas this one, a good example of an exhaustion gap, and although the market continues afterwards in the trend, have a little look, guys, what happens. It comes off, you know, a nice couple of dollars. It comes off, you know, DuPont, they come off 6%, 7% nearly. Okay, that's a big move. That's a big move. If, you know, a currency moves 6% or 7%, we'd be very, very happy, wouldn't we? So, when it comes to trading exhaustion gaps, they are my favorite ones to trade. Now, what sort of things, guys, do you think you'd be looking for to help you with that exhaustion gap? So we're on a daily chart, okay? And we find a gap. Let's have a little look for an exhaustion gap. I believe Apple had one. No Apple on here. Let's try Caterpillar. And there is a nice example of an exhaustion gap, actually. But I have just lost it. 1 second, guys. Okay. There it is here. Now again, very illiquid, so see individual stocks are not my favourite thing to trade this exhaustion gap on. But what sort of things do you think are good for helping you find an exhaustion gap? What do we think, Brenza, Boy Robot? When we see an exhaustion gap, so we come to market here. Okay. We've had a very, very nice move up. We'll pretend that that down move hasn't occurred. We've had a very nice move up. Okay. And then we get a gap. Now, an exhaustion gap is something you have to wait to form. But generally, when I trade an exhaustion gap, it's very, very simple. I will not trade it when we gap higher because it can be a sign of a continuation gap. Pattern, says Brenza. You're absolutely right. We'll talk about that in a second. Generally, guys, these exhaustion gaps can't be traded on this actual candle here because it could be a continuation gap and we could continue moving. But generally, I will wait for the whole day for that pattern to form. And then if I get a nice shooting star, okay, if I get a nice chart reversal pattern, that will help me to decide whether or not I'm going to enter into a reversal trade. As well as that, okay, guys, very, very simple. Oscillators. Easiest way to tell if a market is exhausted. And we can see with Caterpillar, they haven't been overbought for how long? And as well as a continued move higher, we have divergence. And we can see volume again. Okay, so you can see how, exhaustion gaps can be very, very nice to trade because they're the easiest to determine potentially if we're going to reverse. And the reason they're the easiest is because it's always easy when you see an oscillator overbought, good volume, a reversal candle, and you see, you've had a big, big move up. Okay, it makes it very easy to trade. But there is one super duper way of trading exhaustion gaps. Okay, and we're going to talk about that in a second. I'm going to teach you a very, very quick method. So guys, any questions so far about gaps? As I've said, we cannot trade the exhaustion gap on the actual day it forms. We have to wait a day or a period. And oscillators are a good way. Any ideas, guys? Any questions? Anything you want to talk about? Everyone understand everything so far? How to trade. Right, well, this is the thing. I am going to teach you a very, very good strategy of mine. Okay? But I'm afraid to say you're going to have to tune in next week for that. There will be 3 strategies, guys, based on Tradimo ones that are available for Gold and Platinum members. So have any of you seen them? The gap and the advanced gap, have you read those before? Nope. Says Bottle Torch. Frenza. What about you, Boy Robot? Well, how about this? Come next week, guys, and I'm going to give you a session on those strategies. Okay? Cliffhanger, absolutely. Okay, I'm not going to do it today. I like the fact that I've got you on tenterhooks. No, basically, guys, I want you guys to learn these strategies. I want you guys to learn how to trade with gaps. Okay, I don't necessarily. I'm not saying you should trade with them, but these are very, very good strategies. These are my strategies. Okay, and I'll even backtest one in the room for you. The advanced gap one, you get very few trades in Forex and indices, but when it occurs in Forex, it occurs very infrequently. You might get a trade a year if you're lucky, yeah, or 2 trades a year if you're lucky. In obviously markets that close, you get a lot more trades, but it is an absolute peach. And I'll also show you how you can optimize it a little bit. Not necessarily bet the house, but I'll be honest, it's made a lot of positive trades. You know, you're talking about a trade that will make maybe on a daily, because it's a daily time frame, you know, 500 pips, 1,000 pips, um, and you know, potentially, you know, the loss will be quite insignificant. But I'm going to show you the I'm going to show you the optimal system for it. We're not going to use the gap as a profit target. I'm going to show you how you can hold it long term. Bet the dog. I don't have a dog anymore. My foster dog Charlie has gone back to the UK today, Brenza. Very sore subject that. I'm upset today. They found him a home. Yeah, he's gone back. I was only looking after him for a few months till they found him a home at the local dogs pound. So he's gone today. So shouldn't have said the dog. I'm upset. Maybe I'll cry. I only had him 4 months, to be fair. I was just looking after him for a few months just till they found him, because there's a lot of stray dogs in Spain, so I try and foster. I'll take one at a time or two, and we'll try and foster them. So just till they find them a good home. Right, guys. So next week, I want you tuned in for the gap strategy. As I've said, there are 2 ways to trade gaps, and then there's the third super duper duper way. Okay, my way. We either wait for the gap to fill, or we wait for the gap to fill and then reverse. So there are 2 strategies that I'm going to teach you next week. There is a third strategy that I'm going to teach you as well. It might be that we have to do that the week after, but it's going to be a really good session. Okay, guys? So make sure you tune in. I simply don't have time to teach you in one session tonight. I want to make sure we spend a whole session on it. Okay, is that okay, guys? You happy with that? Good. Okay, so anyway, in terms of trading gaps, just a few points at the end. Best way to trade the gap is obviously to check sentiment. If news is out and you get a you get a gap that breaks out from a range, you know that's likely to be a breakout trade. If you get a gap that occurs within a range and there's no news and nothing out, you know it's a common gap, so you can use it for formulating profit targets. So it's usually just used for profit targets. As I say, fundamental sentiment is generally behind continuation gaps and gaps that break a range. These are a peach. I like these, and exhaustion gaps I always like. They're not the reason for common and exhaustion gaps. So for that reason, guys, you have to, you know, bear in mind that generally there may not be any news out for those. The common gap is the one where there's least news. For every sort of gap, I have a specific strategy. I have a strategy for exhaustion gaps, yes, and I'll show you that either next week or the week after. I have a strategy for trading breakout gaps, depending on my sentiment of the market. So yes, and I will show you those next week. You'll see those 2 next week, or maybe I'll show you the exhaustion gap first. Who knows? But you'll be learning these strategies next week, guys. Also, guys, gaps that take place will generally take place over the weekend. They are stronger when they apply on a daily chart. The other thing to bear in mind, guys, is you're more often to see a gap on a Friday potentially than other days, and the reason is because of profit taking. Okay, obviously Monday is the most common day for a gap because of the weekend, but Friday can also be quite common. Okay, and gaps are subjective. Okay, it looks very nice on this chart when we pull up and we see, you know, a nice gap trade in the S&P, you know, here where we feel that gap and we say, oh well, this is a range gap, it's a common gap, we'd only use it for a profit target. But we don't know, that could easily turn into, continuation gap. There could be a bit of news out as to why we move higher. So when that gap occurs, it is a subjective thing. So just try and bear that in mind, guys. Right, I am going to love you and leave you. Guys, the gapfinder.mq4, okay? You need to open it. So what I'm going to do is I'm going to take you through how to install it before we go. So you download it, okay? Like we see here, we open it, okay? We file, we save as in our indicators. Everyone doing that? Everyone done that? Are we doing this now, or should I just do it and then you can do it, look at the video after? Good. Okay, Brenza has. So we compile it. We will see that there are a few errors. It doesn't really matter, guys. It's just to do with the M600 build. I am having one built that will be super duper though. We then, in theory, close this, and go to our chart. Okay, and we should see if we restart our MetaTrader. This is always fun. Should be in here. It might be in our other MetaTrader. We may have saved it into. Sorry, we may have saved it into the other one, guys. In fact, I've opened the wrong MetaTrader. There you go. That's me being a bit of a donut. Apologies. We allow it to do what it wants to do. We open the custom indicator. What the heck? Maybe it's in the indicator folder. Okay, so now I'm having trouble, even though I've installed this before. Wow, this is interesting. Okay, so I'm going to open this into here. Open my downloads. So go to downloads. No downloads in the box, blimey. Okay, so let's try that again, shall we, guys? Right, download the file. Ah, you have it, Brenza. Okay, good. Okay, I need to get it so that we can do it. Okay, I am now. Stop doing that, please. So I am now going to open this particular compiler. I'm now going to bring this particular file share up, make it smaller, drag this across here, drag it in, and file save as gap finder MQL4 should be in the indicator. Compile it, go back into my MetaTrader, refresh this. There you go, gap finder. We have it. Okay, so you can have a minimum size of gap. So if you want it to be a little bit better, so you don't get too many lines, you can set it as bigger. You can have extend the bars to 100, so it will extend. It will actually extend the gap, so you can actually see it a little bit better. So if we say 10, and then you can have history. It will go over the last 1,000 candles. Okay, and then what you will find is that for some reason we have no gaps listed on CAD apparently, because they are bigger gaps. So we go to indicator list, we edit, we set it to 2, and there you go. Okay, and what you will find is it looks messy. I generally have it set to sort of 5 or 10 pips so that I don't have all of these, because otherwise what will happen is it will show you the gap, but it will also get very, very messy. That is why another reason the extend bars is always good to have, maybe just 2 or 3 bars. because it just makes it less messy. So you can see we have an open close gap here, we have another open close gap here, okay, and we can see obviously we have another open close gap, and so on and so forth, and it actually just marks up the gaps that occur. Now generally you know, these aren't the best gaps, but I like obviously the high low gaps. So you know, if we were to stick our DAX on here, we can see obviously if we zoom out, loads of gaps all over the place, and that is one of the problems with it, which is why my settings are generally, you know, minimum gap size is a little bit bigger. In the DAX it's a lot more than that, and the history I just have it over the last 10 bars, okay? And what I try and do is I use that to just identify when a gap has actually formed. So what you can actually do, guys, is if you even want, you could have it over the last 5 bars, okay, because it will help you to identify when a gap occurs, okay? And as I say, I generally use it for the bigger gaps. I won't use it for the small. So, you know, again, we go to indicator list, we go to gap finder, we change minimum gap size to 20. That's going to be pipettes, isn't it? So all of those, but it will help you guys filter. So have a play with it. I have got one being built that will be nice, but you cannot see Brett Boy Robot. Talking to Brenza about the bullish engulfing in the S&P. Let's have a little look, shall we? Which time frame, mate? On the daily? Huge today, yeah, huge up move today. Massive bullish engulfing. Problem is that bullish engulfing hasn't occurred at the bottom of the market like this one after a down move. It's occurred, you know, in the middle. So, do we continue? Who knows? Right, guys, anyway, what I'm going to do now is I am going to call an end to the session. Make sure you tune in next week, guys. Okay, because you are, oh, excuse me, because you are going to have a session with me next week on actual strategies for gaps next Monday. Before I go, we will just pop onto Tuesday and see what's out tonight. We can see that there's nothing out tonight, which is good. If we go to the 18th and hit apply, bit of data tomorrow afternoon, guys, and late morning we've got some ZEW. Okay, we have got minutes of the Aussie dollar meeting, so that if you've got any Asian or Aussie crosses on, be careful. As well as this, we have got ZEW economic indicator. That is a moderate mover, guys. So again, if you've got any euro positions on, again, be careful. We will be back for this though, so do not fear. And then in the afternoon, lots of US data. So lots and lots of data, lots and lots of speakers. I will be back at 9 o'clock to take you through that tomorrow, guys. Right now, I am going to love you and leave you. Brenza, Bottle Touch by Robot. Have a little play with that figure. With that gap finder, and I will give you the new one that I get when I get it finalized and made. Okay, guys, see you later. Hope that was a not interesting and a very easy introduction, because next week we learn the strategy and we're going to test it. We're actually going to get in there and test it. See you later, guys.